Welcome to our fourth quarter and 2023 market commentary. Let's begin by looking at the heat map. A strong November and December propelled the S&P 500 index to a powerful quarter and calendar year return. The index posted an 11.7% return for the quarter and ended the year up 26.3%. The index has been up over 25% 3 times in the last 5 years. Positive seasonality, a better than expected third quarter earnings season, falling interest rates, and the expected end of Fed rate hikes boosted U.S. equities. While this is all positive news, I want to put the year of performance into perspective. For the most part, 2023 was a reset year as the return for the S&P 500 only recouped the losses from the previous year. Narrow leadership drove the markets for most of the year. The Magnificent Seven dominated market return for most of the calendar year. This group is made up of mega cap stocks, Alphabet, Apple, Microsoft, Amazon, Meta, Tesla, and Nvidia. As you can see from this chart, the combination of those 7 delivered an exceptional return for the year, and while the market returned 26%, the remaining stocks only returned 10.4%. Diversification was not rewarded. On a positive note, market breadth improved significantly in the final months of the year. Nearly 75% of the stocks in the S&P 500 now trade above their 200-day moving average, which is a positive development for broader market performance. Before turning to fixed income, I want to look at 3 data points of style box returns. The first depicts the 2023 return. 2 items to highlight are: 1, larger companies generally outperform smaller companies, which can be attributed to the Magnificent Seven, as well as the fact that growth outperformed value. The next style box details 3-year cumulative performance. What is noticeable is that the return of value-oriented companies is more competitive with their growth counterparts, with meaningful outperformance in the mid and small cap categories. The final style box illustrates the same data over a 5-year period. The narrative flips back to that of 2023, large companies over small and growth over value. I show you these because I believe it supports the importance of diversification and risk management. The fixed income markets had a rather historic year. The Bloomberg U.S. Aggregate Bond Index returned 5.5% for the year. However, the interesting story comes from looking at the monthly returns. To begin, the index delivered a 4.5% return during the month of November and a 6.8% return for the quarter. The returns are the best monthly gain since 1985 and the best quarterly gain since 1989. This came after 6 consecutive months of negative returns, the longest streak since 2017. Bonds rallied into the end of the year as interest rates declined sharply on the back of rising expectations for Fed rate cuts in 2024 and a further moderation in inflation. I find it interesting to note that at the end of October, the aggregate bond index was down 2.8% and appeared to be on pace for its 3rd consecutive year of negative return, something that has never happened. While the strong performance of the index in November and December saved the year, it also highlights a point I made in my 2022 market commentary that bonds were looking attractive once again. Let's revisit those comments and charts. First was the fact that yields were meaningfully higher. This chart compared the yield on respective fixed income investments from December 31st, 2021 versus December 31st, 2022. I highlighted that the 2-year Treasury bond yield now was equal to what junk bonds were yielding when the year began. Second was the concept of duration. Bonds compete against each other on the interest income they provide to make them seem attractive to investors. When interest rates go up, newer bonds have higher interest rates, so existing fixed rate bonds must sell at a discount to compete. When rates decline, the opposite happens and prices rise. Duration is the mathematical formula that measures price change. This chart depicted the impact to price from a 1% rise or fall in interest rates. The 10-year Treasury reached a closing peak of 4.98% during October and then subsequently fell to 3.88% to close the year. This decline in rates and the concept of duration is what propelled bonds higher in price. Volatility was high this year, and yet the 10-year Treasury ended the year near the level it started at. With that being the case, I am going to reiterate my statement that bonds are back. Fixed income still appears as attractive as it has been in a decade. Please contact me if you have any questions. Thank you for your trust in us.